This content is for informational purposes only and does not constitute investment advice. Always conduct your own research or consult a licensed financial advisor before making any investment decisions. Over the past week, silver has risen by nearly 9%, reflecting a sharp surge in momentum. In response, call options on SLV, the ETF that tracks the price of silver, saw intraday gains on the 5th of June 2025, ranging from approximately 300 to 400%, highlighting heightened investor interest and leverage positioning in the market. This is for informational purposes only and not investment advice. Past performance is not indicative of future results. Stick with me till the end of this video, and I'll break down exactly why silver just had one of its biggest moves in over a decade, and why this could be just the beginning of something much bigger. Silver is shaping up to be one of the most compelling assets in today's market, and its recent surge to a 13-year high is just the latest confirmation. At $36.24 per ounce, silver has finally broken through key resistance levels after months of lagging behind gold. And this breakout comes amid a backdrop of powerful supply and demand dynamics, accelerating industrial use and rising investor interest. What makes this even more interesting is that the gold-to-silver ratio, currently around 94, has started to fall from extreme levels above 100, opening the door for silver to play catch-up in a major way. Looking back over the last 100 years, the gold-to-silver ratio has mostly ranged between 40 and 80. Today's ratio around 94 is historically elevated, which could mean either gold is overvalued, silver is undervalued, or a bit of both. If silver simply reverts to the historical average ratio of around 60, it implies significant upside potential. And with a thin, volatile market, technical momentum can amplify these moves quickly. And this isn't the first time silver has made a dramatic move. Back in 1980, silver briefly hit $50 an ounce when the Hunt brothers attempted to corner the market, believing the fiat system was nearing collapse. At that same time, gold hit $850, creating a gold-to-silver ratio of just 17-1. In today's terms, if we return to that historical ratio with gold around $3,400, silver would need to trade at roughly $200 per ounce. While that might seem extreme, it highlights just how undervalued silver is today when compared to historical norms. The gold-to-silver ratio is a simple way to compare how expensive gold is relative to silver. It tells you how many ounces of silver you need to buy 1 ounce of gold. For example, if gold is $3,400 an ounce and silver is $34 an ounce, the ratio is 100. That means it takes 100 ounces of silver to equal the price of 1 ounce of gold. When the ratio is high, it usually means silver is cheap compared to gold. When the ratio is low, silver is considered expensive relative to gold. Investors sometimes use this ratio to decide whether to buy more gold or silver, betting that the ratio will eventually return to its historical average. The fundamentals are clear. Demand for silver continues to exceed supply, and 2025 is on track to mark the 5th consecutive year of a global silver deficit. That's not just a short-term squeeze, it's the result of deeper structural issues. Silver mining peaked back in 2016, and many of the richest deposits have already been depleted. Today, only about 25% of silver comes from dedicated silver mines. The rest is extracted as a byproduct of mining other metals like copper and gold, meaning it's not easy to simply increase output when demand spikes. Recycling has helped a bit, but it's barely enough to offset the decline in production, leaving total supply effectively flat over the past decade, while demand steadily grows. And the demand side is booming. Electrification, clean energy, and digital infrastructure are all major growth engines. Silver is the most conductive metal, outperforming even copper and gold when it comes to electrical and thermal efficiency. That makes it essential for high-performance technologies. A conventional internal combustion engine vehicle might use 12 to 30 grams of silver, while electric vehicles use 25 to 50 grams. But with next-generation solid-state EV batteries just around the corner, set to roll out commercially by 2026 and in mass production by 2027, each vehicle could require up to 1,000 grams of silver. That's 20 times more than the current average. Silver is also critical in solar panels, with each panel requiring about 2 grams. As solar installations surge, expected to grow 26% in the US and 10% globally this year, so does silver consumption. And with AI, data centers, and military systems all relying on advanced circuit boards, the industrial case for silver keeps expanding. Even without these industrial drivers, silver stands out in a world grappling with inflation. As fiat currencies lose purchasing power, something everyone can feel, whether it's groceries, housing, or a movie ticket, hard assets like silver serve as a store of value. Since 1971, the cost of living has skyrocketed, driven by money printing and expanding government debt. Silver, like gold, protects against that. But silver is not just a hedge. Right now, many believe it's poised to outperform inflation due to its tight supply conditions and surging demand. Historically, silver has always had monetary value. It has survived empires, hyperinflation, and economic upheaval. From the Roman Empire to early America, silver was money. And while it no longer backs currency, its role as a reliable, tangible asset remains. Investors are increasingly recognizing that silver isn't just about preservation, it's a growth story. In 2011, silver experienced a significant rally, rising from approximately $35 per ounce in late March to nearly $50 per ounce by late April, a remarkable increase of about 40% in just under 6 weeks. Specifically, silver reached $49.82 per ounce on April 25, 2011, marking its highest level in over 3 decades. Recent reports indicate that major banks hold significant short positions in the silver market. As of early 2025, data shows that these institutions have net short positions totaling approximately 44,583 silver futures contracts, equating to around 223 million ounces of silver. Some analyses suggest that bullion banks may have even larger exposures in the London physical silver spot market. If silver prices continue to rise, these substantial short positions could lead to significant losses for the banks, potentially triggering a short squeeze. Such a scenario could amplify upward pressure on silver prices, as banks may be compelled to cover their positions by purchasing silver at higher prices. Given the relatively thin nature of the silver market, even modest shifts in demand or sentiment could result in sharp price movements. If you found this breakdown helpful, don't forget to like the video, drop a comment with your thoughts on where silver is headed next, and subscribe to the channel for more deep dives on precious metals, markets, and macro trends. Thanks for watching, and stay sharp out there.